Today is Monday, July 31st, and this is the ADM Investor Services Weekly Market Kickoff. Today's guests are Steve Freed, Vice President of Grain Research here at ADMIS, and Matt Krupski, Senior Market Strategist at Archer Financial Services. Matt, the VIX index reached new record lows last week before rebounding. What's driving this index, and can these low prices continue?
Sure, great question, Erin. One way to look at the VIX and what the VIX really is it's a measure of option prices. So when you tell me the VIX is low, all that says to me is that prices are cheap in options. So when you ask me why is the VIX low, the real question is why are options so cheap right now? There's really a variety of reasons to approach that answer. One of them is there's not a lot of hedging going on because a lot of people have missed this rally. So if you're not in the market, you have nothing to hedge, so you have no options to buy. Secondly, selling begets selling. So option writers right now have been obviously making money hand over fist because realized volatility is low, so they're selling options and just making money, letting them melt away to nothing as they never get threatened to go in the money. So since they're not being threatened, they can continue to come in and sell more and more options, which depresses prices even more. And finally, across the index in the S&P, you're seeing correlations at record levels as well. So what that means is that as one stock may be going up, another stock may be going down, so you're not seeing any kind of movement in the actual index. You're seeing a lot of movement in the names, but that doesn't result in volatility in the index. So I think those are three things that are contributing to this low volatility. I don't see anything that's going to make it change right now, so I do see it continuing.
And despite continued federal deficits and the record national debt, gold remains well off its all-time highs. Is this undervalued?
Say gold is undervalued here is a real tough sell for me. Despite the large deficits, the real two main drivers of gold historically have been, one, a store of value, so in times of craziness, when the war breaks out or uncertainty, people flock into gold to hold their value of their money, and secondly, an inflation hedge. So generally when you have those deficits, you have this QE that went on a couple years ago, you see inflation. But we're not seeing that money get put into the system, so you're not really seeing a lot of inflation right now. And until we do see some sort of inflation, I think gold prices are going to stay kind of where they are right here. The real question to me when you're looking at precious metals is why is platinum so low? Relative to gold, platinum is more rare and generally trades at a premium, but for years now we've seen platinum trading at a discount to gold. So if you're looking for an investment in some sort of precious metal, I would be looking more towards platinum rather than gold right here.
And crude oil has had quite a run this month, trading back to almost $50 a barrel. Will this uptrend continue?
For the uptrend to continue, it needs a lot of, I think, demand stimulated across the globe. I think a lot of this rally we've seen recently has been due to a couple things. One, you've seen the dollar really just kind of fall out of bed. So as the dollar gets cheaper, dollar-denominated assets become more attractive to everyone else in the world. So you have more global demand for crude. And secondly, we're coming off of record levels of crude oil. You see inventories start to draw down over the last month, which has resulted in slightly higher prices back to the $50 level. I think going forward, the two main keys to look at are what's going to continue to happen to those inventories. If we keep getting drawdowns, then yeah, I think this rally could continue. I'm not sure that's going to happen. The key thing to keep an eye on, I think, is rig counts. If these high prices continue, you're going to see more and more oil rigs come back online. As that happens, you're going to see more and more oil produced, which should put a little cap on prices.
Steve, traditional funds are selling out longs. Why, and will this continue?
I think the main reason is that they've been adding longs because of the weather premium, and now with a 2-week forecast, it's cooler than normal. Not a lot of rain across some of the dry areas of the southwest, midwest, but the lack of heat is forcing them to liquidate their position. So if they don't see a bullish report on the August 10th USDA crop report, they could continue to liquidate longs and push prices lower.
And what will the USDA say in their August 10th U.S. World Report?
Early guesstimates are that the corn crop could be around 13.9 billion bushels versus the government's 14.2, and that would be a 166 yield versus their 170.7 yield. In beans, there's not much of a change, maybe down 40 million bushels from USDA numbers, and that's a little under their 48 yield. Carryouts in corn for next year could be $1.9 billion versus the government's 207.5. Beans could be 440 versus 416, wheat 900 versus 938. Again, not a big enough change to attract new buying. So on the world numbers, they're not expected to make a lot of changes on the world numbers. And so after the August 10th report, we'll probably try to slip into some harvest lows.
And what is the seasonal trend in corn and bean prices over the next 12 months?
In a normal year, we tend to trend lower into harvest lows. And then once we establish those lows and harvest is over, we tend to bounce into January on uncertain South American weather. And then after that, if there's no problem, we make new Fed lows in the grains. And then after that, we tend to add some premium into the May-June timeframe on uncertain weather for next year's 2018. So we'll probably stay in a relatively tight trading range, but making lows at harvest and maybe in February and highs in January and June.
Please remember that the opinions expressed here today are solely the opinions of our guests and are not necessarily the opinions of Archer Financial Services, ADM Investor Services, or Archer Daniels Midland Company. If you have any questions or comments or would like to know more about our services, please contact us at www.admis.com.